Hello, ladies and gentlemen, and welcome back. Well, what a big end to the week. A bullish one, finally, after a subsequent weeks down for quite some time. We've been in a coiling market range. Does this break that range and move towards an upper band ahead of inflation and, of course, earnings season? Yes, the US is just heating up in terms of data, and I've spent a bit of time having a think about the services PMI, manufacturing PMI, and what the algos just did over the last 24 hours. It looks like the bulls are back, but are they really? It could be short-lived. Let's talk about everything to do with stocks, commodities, and cryptos moving forward. This is going to be a good one. Well, welcome back, everybody, to the Daily Show. We've got a massive jam-packed show today. Lead news, macro data, key indicators, and then, of course, the big levels that you need to be watching. But there's just so much to unpack. Let's begin with, of course, the non-farm payrolls. So the Dow Jones, Sp500, Nasdaq, they were all up heavily, and they were all going up on signs of slowing wage growth. Yes, bad wage growth is supposedly a good thing when you're trying to deal with inflation. Now, that was only one part of the story, so stick with me as I go through the next parts. But basically, the December employment report showed that, the jobs are still there and they're still coming through. But at the same time, we are seeing a little bit of a slowdown in wage growth. Here's a chart here shared from Marko Bejevic on Twitter. And it says here the average hourly earnings month on month annualized 3 month. And you can see here the declining level of that. It also looked like there were quite a few people picking up secondary jobs just to really break even in terms of their current situations inside of the market. I shared over on Twitter some information about the PMI number though, and make sure to follow at FX Evolution over on the PMI numbers. But to start off with, let's have a look here at the non-farm employment change. Where were the jobs found? Pretty much the normal sectors for the December period. This is pretty normal to see, especially leisure and hospitality making up one of the strong sides, health and education doing well. And we saw professional and business services and information technology both drop. And this is those layoffs coming through tech. Probably something we continue to see, layoffs through tech, layoffs through financials and businesses. I would expect to see that continue in 2023. So here's the story right now, and it's a big one. So we saw that the PMI services dropped, and it went under 50 for the first time in quite a while. Now, it's tended to be that manufacturing PMI and also services PMI have led recessions. And when both have gone underneath 50, it was not long before the Fed would pause and pivot and move back towards stimulating the economy. At least that was the rule book for the last kind of 12, 14 years. If we take a look over here at Viraj Patel's chart, he basically goes through and he shows that there were periods in time where we saw these data points get really negative, and then we saw Fed pivots straight up after those points. And these are the circles that are here. Now, straight away, I'm sure many of you are about to type in the comments, this time is different. And absolutely it is. We're trying to combat inflation at the same time as we're going to cause a recession in the US. Pretty much this is assured it. And then at the same time, you're saying, well, we need to stimulate that. And the market was going haywire both sides. It's very confusing macro. I've seen so many different opinions on this, and I think it's really difficult to break it down. Was the non-farm payrolls maybe positive towards the Fed's goals? Yes, dropping wage growth theoretically is part of the beginning of basically dropping inflation. But now it's that Goldilocks scenario. Can they actually come in and support the market from what the market has just told us? We saw yields drop across the board over the last 24 hours. China may ease the 3 red lines property rules. Hey, there's no doubt here there is problems in China. I've said it for a long time. We all have here on the channel. This is the story of the decade. China's property market is in really bad shape. Now, will they be able to support it for now? I believe so. So people that I think there was a lot of articles saying that China was going to blow up in 100 days and all sorts of things were happening on their economy last year. That was very unlikely. This is the first sign, though, that we're getting relaxed lending and probably unscrupulous lending coming back into the markets. And once this happens, they're going to start something that could look like Japan in the late 80s, early 90s. overblown, like big buying, everybody getting hyped, really bad lending standards. And then, of course, we all know how that ends really, really badly. Will it happen this time? I don't think so. I think it's going to be a little bit further away. Let's talk about Sp500 index and the inflection points. As we know, it's at kind of historical fair valuations. Remember to watch this throughout 2023. Forward PEs at around 17, which is where we are right now, is technically fair value. But once we start to move a standard deviation away from that, let's say like a 14 or a 15, this is going to be one of those times that investors come in and say, geez, I'm very excited about these prices, even though everything may look terrible at the time. You can see some of the forward PEs down the bottom here, went as low as 10 during the global financial crisis. So it can go lower. It's just a very interesting time. And at the moment, we are at what's called fair value, I guess, over the last 20 plus years. Smart money versus dumb money. If you don't want to believe in this current rally that's happening in markets, you want dumb money to overtake smart money pretty heavily here and basically start to purchase in a very heavy form over the next 1 to 2 weeks. We'll be following this story, so make sure to subscribe to the channel because guess what? We'll be covering it. We have to. This is a very big story coming through. We also had an inkling that markets may rally off whatever this number was going to look like. The main reason was that small traders were getting all hectic on puts. They were basically buying a ton of puts in recent weeks, and that's because the Santa rally didn't come. We also know that doesn't bode well for Q1 and Q2 in terms of the data. We've shared that a few weeks ago as well. Check out some of those videos. Call premiums, of course, were under put premiums. They're going to have to do a bit of a switch for us to be able to go back down. If we clean the data up here, you'll notice some of the points, the most notable 2008, where we got into a bit of a kangaroo market for a while and then had that final capitulation level. That would be something that I'd love to see during 2023, mostly because it would be in line with what we've seen before. Very high VIXs, potentially putting the bottom in for markets. When it doesn't happen like that, similar to what we saw in 2022, I'm always a little bit nervous that the worst is still to come, if that makes sense. You want to see a high VIX. I know it sounds ridiculous, but that usually marks at least some kind of fearing bottoming of these markets. Panic euphoria model was another one that I didn't quite share as much, but it just shows you that we had a huge amount of panic coming through in SEBs in the last couple of weeks. And when we've had these types of readings in the past, you've got to say the annualized return was pretty strong, that it was quite positive. So yes, I mean, are we going to get a bit of a rally here? Well, maybe, and we'll talk about the key levels in today's video as we go through. We also saw down volume outpacing upward volume, that being a short-term decent buy signal. But when we've had this in the past, usually we've been making new lows. Remember that? This time around we weren't. We were just kind of in a coiling pattern. And that was showing us that maybe some buyers would come back in. Let's have a look at some of the negative news, though. We had some big ones. New York Stock Exchange 52-week low starting to expand again. This was a big deal last time when we've had rallies that were pretty big that came off some of the economic news. They were false rallies. They were dead cat bounces. So are we going to get that again? That's an interesting one. We're currently in the stages of this potential rally. Remember, when we've had these data points in the future or in the past, we've usually led into a 1 to 3 month kind of struggling for the S&P 500. The same thing goes with the MACD switch with the 200 moving average. We used this little over 3 to 4 weeks ago to show us that most likely the market was going to false kind of rally and then move down. That's what it did. Now, again, we're about 1 month into that. So still 2 months, 3 months, even 6 months later, the data is fairly negative towards when we get these bigger indicators coming through. Remember, some of the others are more short-term ones like the puts, the small traders. What do small traders tend to do? They buy puts 1, 2, 3 weeks in advance. They really don't tend to go a quarter in advance or even months in advance. So we need to remember that there are short-term time frame kind of data points and there are long-term ones. And at the moment, the long-term ones still look relatively negative and the short-term ones kind of justify why this market is potentially moving up here. Let's have a look at another thing that we noticed in the last 5 days, which was rotation. We saw some of the defensive sectors become the worst performing sectors, and we actually saw things like semiconductors, metals, communications start to take hold of being the strongest sectors. Take a look at the last 24 hours. If you'd picked some of those ones, metals, semiconductors, XLB, technology, all of those ones that were starting to turn around, doing really well. Whereas the defensives, if you notice, were some of the worst performing sectors. And this is just showing you why it's so important to understand the rotation under. Once we saw that rally come through, it was absolutely smashing for materials, for TAN, for semiconductors. They all went through the roof through the session. And there was a really great trade coming through after the non-farm payrolls. It did the standard kind of move up, pulled back for liquidity, and then rallied heavily through. We'll take a look at that in the charts very, very soon. What about earnings? Well, it's that time of season again when earnings is about to kick off. It's coming up this week. And we start off with the big banks, or some of the big banks, on Friday the 13th. Is that an ominous signal? I'm not sure. Friday the 13th. There we go. And then on the 17th, we've got the big ones like Morgan Stanley, Goldman Sachs. And the banks will begin it. Netflix will begin the big tech. And then we'll jump through into Tesla, obviously, on the 25th. So Q1 earnings, or all of this kind of earnings data, is about to come out. And we know that also we have inflation numbers coming out. So this week is going to be massive in terms of the implied volatility, the options movements, the expected moves. Big moves are coming on these markets, and you wouldn't expect it to be, not volatile. It's going to be volatile after we get the start of this news. Let's take a look at the VIX. Where's it looking? It's 21.14. So the volatility index isn't exactly mounting a huge pickup. I wouldn't be surprised at all before some of this news for the VIX to be a little bit higher. Even if the market is rallying up, we've got the biggest bit of information coming out, which is the inflation numbers. And then, of course, we have the beginning of earnings season. So, yeah, VIX sitting about 21.14. Nothing too surprising there. Now, the elephant in the room that we mentioned before was the JP10Y. It's the story of 23. They've just come under pressure, forcing the Bank of Japan to obviously intervene. Well, they must have. No one else probably was doing this. And what happened was it breached for the first time, which we've had previous breaches, of course, at the 0.25. It breached the 0.5. And I think that the Bank of Japan is going to have to reverse course and start to raise this. They've basically begun it. So it's clear to me, at least, that I think over the next subsequent months, we're going to see them put the ceilings up. But this is just, it's basically a monetary policy disaster. Let's face it. The Bank of Japan has made big mistakes. They've been doing it for a long time now. Do we have to worry about it? I still think it's a huge story. The question is, what does it do to affect us? So there's a lot of information out there, lots of fear-mongering stuff, don't get me wrong. The question is, does this really affect us right now? And I think it's more of a discussion around probably treasuries, and we'll come back to that. We'll do a special on it in the future. I wanted to bring this one in because a lot of people have been sending me natural gas charts saying, do you think it's a buy here, et cetera, et cetera. I don't blame them. I mean, it's absolutely at a key demand zone. We saw a little bit of a pickup in the last 24 hours. But what I really wanted to highlight on this chart, and it's just for everyone out there, is I'm seeing so many people saying, oh, Tesla's super cheap and, it's making so much more percentage than Ford is and everything like that. And they're saying that, of course, that means that the stock should be going up. Well, wait a second. That's not necessarily true. I mean, there's other things that go into it. What I'm pointing out, though, is that everyone I was talking to was saying, oh, natural gas has got to go up. We're going into a European winter and everything's going to be horrible and price is going to spike and everything. Remember, the price spiked into the winter. The price spiked into that period in time. So realistically, what tends to actually happen is you get that kind of buy the rumor and then sell the fact. Now, in this case with Tesla, potentially we're seeing sell the rumor and then buying of the fact. Okay, that's the way it is actually playing out. But I just want to really bring up natural gas here because you could say, well, it's been the hottest on record in terms of winters, et cetera, that hasn't been as much demand on natural gas. Look, believe me, I believe natural gas was already going to be, relatively speaking, lower. And even with these rallies, was still going to drop through. And it's just that really clear idea of, if you don't believe me on this type of stuff, have a look at Amazon. Have a look at how it tends to trade into Black Friday and then tends to trade after Black Friday. You'd be surprised. What's everyone thinking around Christmas? Time to buy Amazon. It's a great time to buy Amazon. Everyone's going to be spending. The market doesn't tend to work that way. It's already packed it in ahead of time, and you need to be able to see this and recognize this. So I think natural gas was just a good one there. If we take a look at the 2 hour, just to see whether it actually has mounted any type of comeback, this is a fairly significant level for it. You can see around this 3.7. They call this the Widowmaker because it's a crazy percentage move generally on natural gas. But if it does rally, you could say that maybe it's found a temporary bottom, moving towards maybe $4 in terms of this one. Interesting chart, great to bring up. Let's look at yields moving forward before we get into some of the stocks and other leads. We saw yields doing a major thing here, 4.87. They dropped significantly on some of these forward yields. This is the September one. So it was hitting 5% after the Fed dot plot. Then it dropped down to 4.87. Now, one thing I want to say about the FOMC meeting minutes is they basically said that they don't perceive, and this is what they said last time, they don't perceive that they wanted to drop rates throughout 2023. So effectively, they were going to raise them and hold them. That's what they said. I mean, they didn't say anything else. Now, the market allocated for that and bought back up, and it's sitting at 4.87. But what we did have was a huge move on yields in the future. So if we look here at March 2024, 4.2% is expected. So basically a lot of rate cuts past 2023. It kind of looks like this now, the yield curve. And I'll get an update for the next video. Goes up, hits a level, and then just gets cut way faster than it was previously. And that's been good for, of course, bonds. Bonds tend to perform relatively well in these kind of situations. So let's have a look at LQD here. We'll look at investment grade corps. You can see they had a really good session, 1.64% up. We can look at TLT. Again, decent session here, 1.84% up. And even junk bonds, high yield corporates, had a decent run, 1.42. Now, are we getting a disconnect between high yields and the stock market? Remember, when we've seen high yields theoretically drop before, that's told us that the stock market deserves to be going down. Now we're seeing high yields rising back up. I'm going to have to do a little bit of work on this to see whether they've disconnected fully. I'll let you guys know. Make sure to subscribe to the channel. We'll be following that story. This is an important one because it was so easy to use during 2022 as high yields dropping, and then we saw the market would drop, or the market would drop in unison. That would give us confidence that that move was real, and of course it was very, very scary. So high yields jumped up here, and we saw pretty much a buying across the board of all bonds. Anyone that got into TLT literally about a week ago would be very happy with themselves. Great gains there. Now, what was the punishment? Well, it was the US dollar. Because of all the rate cuts in the future, the US dollar suffered. So remember, a lot of these markets are trading way in the future. They're not trading right now at what you think or perceive is happening over the next 1 to 2 weeks. It's often actually priced in the future. And that's why when we saw those huge rate cuts, especially coming through 2024, the US dollar allocated to that. Now, we did talk about this being kind of like a bit of a buy. It came in, it moved up, non-farm payrolls happened, and bang, all the way back down. Now, could there still be purchasing through here? Absolutely. It could also be that this was all part of a fake breakout though. So if we do end up getting a new low, don't go, oh, that's a great time to buy the US dollar. I would say it probably goes down further. Tough trading environment. It's usual for currencies to be very tough. From about Christmas period to usually around the 10th to 15th of January. They tend to be very, I guess you would say, almost untechnical over those periods, or a bit harder to read through. But yes, that's what non-farm payrolls can do. And unfortunately for dollar bulls, it moved it heavily down. Was that good for our gold concepts? Yes, gold rallied very, very heavily. It actually almost hit those beautiful weekly, daily levels at 1871. So gold's kind of reached a very critical point. We'll come back to that next week as we see more data come through. Let's move through to oil now. Have a look at the oil trade. Oil rallied, but it didn't rally back to 77, unfortunately. Let's have a look at the 2-hour turnaround here. Again, it's just doing a bit of coiling. So whether this wants to break out and then hit 77, still a very key level. I'll set a little alert there for this, just in case it does happen, because that's going to be a pretty key level. I'll trigger that later on. And if we look towards a new low, of course, then you could actually be making an argument for 66 and 65 if a new low is formed off consolidation. So oil, probably a pretty good trade coming up on it, either to the sell side underneath, or of course to the buy side should we break out and then sell maybe around that 77. Key level here for oil, one to watch. Let's move over to the stocks now, and we'll start off with Tesla. So I've updated the new options weekly highs and lows moving forward, and we've got 121 on the high, actually almost filling that gap side, so that's going to be interesting. And on the low expectation, a 104. So pretty wide here for Tesla moving forward. Clearly, there is a huge amount of anticipated volume kind of movements here, and you can see that there's almost 8% in terms of the width of these expectations over the next week. It's going to be a volatile stock. Do we have any signs of what's happening? Well, based on the wicks, you would have to say that there's a little bit of buying demand. I mean, we came back into this level. We've had some buyers. We've had some buyers again. I think the Sp500 will give us more information about Tesla this week than anything else. But remember, and keep this in your mind, coming into the 20th of January, there's still a ton of puts sitting around the 100, and the max pain at the time of this recording, which we'll update right now for the 20th, is sitting around 145. So if that doesn't compress back down, you could still expect that there may be dead cat bounce rallies in Tesla. You've just got to be very, very careful of that stock. Moving forward into the 13th, it's a 116, so only a few dollars above. And you can see here the call walls seem to be sitting around that 120. So I think if we get a market rally into 120, somewhere around that, coupled with, of course, our weekly options high and potentially even gap close levels, they're all sitting within a few dollars of each other. So potentially there might be weakness around this level. And of course, there'll be strength somewhere on that bottoming zone should we get there. You want to trade the extremes more than the middling zones generally with stocks, so something to look at. Let's move over to Apple. Pretty good weekly close here. It actually came down to almost fill that gap perfectly. We saw wick purchasing. We get a new high here. Could we be putting in a bit of a rally here for stocks such as Apple? Of course, we have a gap fill sitting at 143. We have an expected options high of almost 134, and then we have the low of 125. So we're in the middle of both of those ranges. We know that the weekly looks pretty strong. Let's take a look at the 2-hour. 2-hour was pretty okay. We didn't quite get a new high though. So a new break high of something like a 131 will be relatively significant. It was a fairly nice trade day. We actually filled this gap and then rallied through. So I think this is going to be a key level to watch this week, and it looks like little double bottoms kind of put in place. So if we do end up breaking through here, potentially markets rally a little bit more. Again, S&P 500 will show us that. Amazon, did it hit the lows of 2020? It didn't quite. Look at that. It actually made a new low, 81.46, and then of course it rallied through this week. Look at that daily though. Bang, straight down, hits around that level, and then finds buyers, taking out all the stop loss traders that we hear. It was a nasty session for a lot of traders out there. S&P 500 offered the best trade for sure, but this was an interesting one because it went straight back down to that level. 87 plus will be a key level for Amazon this week. The reason why is because we know that that's the previous resistances or the previous kind of supply level. If we do breach through that, then we're most likely seeing further rallies throughout this stock and potentially other tech stocks. Let's have a look at the DAX. The DAX hits the supply area that we've liked for a while, and it closes the week there. Let's take a look at the weekly close. Check it out together. Here it is. So big, strong weekly. I could see the DAX spiking a little bit higher here and then maybe moving down. Again, this market has been heavily sold by retail traders and they're getting punished for it. Not as many people were shorting, let's say, the SPY as they were the DAX and the FTSE and some of the other markets. And they're just getting shellacked for doing that. Realistically, this is what happens, unfortunately, in markets. So we get that big weekly strength. I don't really like this level as much. I think it's a great take profit zone for some people. We're at critical for the DAX and for many of the European markets. Let's now move over to the US market. Big bullish wick close here for the Nasdaq. That's 3 weeks showing us demand is there. If we get a new high price-wise, sitting at around 11,100, that's going to be a fairly critical level to look at for the week ahead. Let's check out the options for that. We'll load up the Qs. Here's the Qs. 276 on the high end is expected, and on the low end, 261. So interesting to see that the options expected lows hit within the previous demand zone. So again, maybe there will be even further buying should it come down to that. I'd like to see a break above 270 on the Qs, movement in, of course, then to potentially options highs for the week, and we'll couple that with the Sp 500 analysis in just a second. What about the Dow? It's done what we thought. Weekly, strong level. We figured this out with using the trend line, the previous structural zone, and of course these wicks. So again, the Dow looks like it's readying itself potentially for a bit of a rally leading into the inflation numbers off the back of this so-called non-farm payrolls and PMI macro data. And we're going to probably an extreme ahead of all of that. Let's check out the SPY numbers here. 396 on the high expected weekly. Now, this just basically means that the 68% of the time options expectation. So basically the market should stay between these two bands 68% of the time during these weeks. So expected weekly options high is 396, getting dangerously close to that gap fill, which sits around 400. So imagine if we do end up getting up here, up that upper echelon of the weekly options high, will that be enough to also stack with the other reasons to potentially force shorters to come in? I would say it's going to happen. If it does happen, it'll happen before the news, and most likely, and then we'll be at these critical zones ahead of the news. Big breakout here on the SPY. You can see it got past the 388 highs, filled tons of gaps as it was doing it. And realistically, they're the levels. Let's have a look at the SPX. This is the weekly close for the real market. Nice bullish wicks, fairly strong bullish close, opens itself out for realistically any sell-offs to be met by buyers at this stage. And if we look at the US 500 futures, you can see that it just hit into that critical zone. Now, there are shorters here. 3,900 to 3,910 is still a battling zone. It went straight into that after doing the fake out we'll look at in a second. And the market basically rallied into this area. So I could see like even a little bit of weakness through here, then hopefully being met by bull demand. And if we manage to get past that 39.10, what's the next stop? You've got to think it's 39.95, 4,000. This is a critical little bit of supply that probably a few people are missing. And it's not out of the woods yet, but it's right into that test. And you can see the sell came right off that level. Was the trade for the day good though? Yeah, it was really, really fantastic. The market made a new low. The market rallied huge into the non-farms. PMI results, I guess, came out, pushing it back down. And then we saw a false breakdown like down here to realistically a huge rally. This was just the market grabbing liquidity. If you've done our advanced scalping masterclass, that's a thing of absolute perfection. You guys know what I mean. It was really nice. Hopefully a few of you picked it up, and it was a classic type of setup happening around news. So yes, that was an algorithm special right there for sure in the markets. So what do we expect for the week ahead? Well, I'd like to see a break of 39.10, and then once that breaks out, we end up moving towards that 39.95, 4,000. I think it's going to be tough trading here, so stick with us this week because we know inflation numbers are coming out and then earnings. We're probably going to be at critical levels. Let's just say we are there ahead of Thursday. Oh, it's going to be a big day. Options probably will be your friend because it'll be scary to be in futures markets. But we'll have so many things coinciding with this zone. As we've spoken about before, we will have the downward trend line sitting straight on that level. We've also got a gap fill. We've also got a 61.8 fib retracement zone. And we have that potential of this being all part of some kind of dead cat bounce. It's a critical level for markets. I hope a few of you can see why. And it's one of those key levels that we were playing with, along with, of course, the 37 kind of 50, 37.40 zone. I don't think it comes down there, but another key level to watch into the future for sure. Yep, that's really, I guess, the close there of the S&P 500. Let's have a look at the options moving forward into the next week, the 13th. We've got a max pain of 385. You can see here 360 puts, 380 puts. There's not much in terms of options floating around there. The big one's going to be the 20th, and it's something that we've argued that market's going to struggle to be low or too low during this period of time because, of course, we have huge amounts of 380 puts. We've got a huge amount of calls and puts sitting around 390, and we're starting to see those calls flowing through. If I was a market maker, what would I want to do? Probably push the markets up, get more calls in, push them back down, expire all of the puts, and then make the big decision on what's going to happen into earnings season, because then we'll see the big tech stocks coming out around this period. Remember the 20th, then we've got the FOMC again. There's so much news, so much manipulation going on in these markets. But at the moment, we kind of favor that idea of hopefully breaking the 39.10, pushing through to 39.95, 4,000, maybe finding a bit of a struggle around that area, selling back off, options expiration across the board, and then we can start the year with a clean slate with less puts in the market. That's going to be pretty important, especially if you're a bear. What about crypto? It was a bit disappointing. I wanted to see this thing through 17,000. I think a lot of us did. 17,000 break would have been good. It did rally into 17K. It had a struggle time here. If the markets keep rallying, I'd like to see, maybe even this weekend, who knows, Bitcoin breach that 17.1 and then start to move towards 17.5, 17.6 in line with the markets going to that 39.95. That would be at least the ideal at this stage for Bitcoin. We'll see whether that plays out. And now on to the big news. As we go through this week, it's going to be massive. So we start off a little bit slow. Obviously, we've got January 10th. We've got the Powell coming out to annoy us all, 9 a.m. New York time. Then we scroll through those Thursday core CPI, the biggest bit of data of the last couple of months. Why there's so much expected volatility in these markets. It's definitely that bit of data right there. 8:30 a.m. Thursday the 12th. It's a blockbuster. And then, of course, we go into prelim UOM consumer sentiment as well on Friday, Jan 13th. On top of all of this, we start off the earnings for the banks. It's going to be a blockbuster month, guys. Make sure to subscribe, smash that like button, and of course, follow us on Twitter at FX Evolution is the handle. Links in the description down below. Thanks so much for watching. Have a great weekend, and we'll see you in the same place at the same times after each day of the close here on YouTube. Bye for now.